Hey, hi everyone. This is Anabadya. Today we are going to start off with the first video in this channel. To all of you who have gone through the introductory video in the domain consulting channel, I think you have heard that I have spoken about the different domains and the different industries that we are going to cover in this channel. So I've listed down, say, about 40 to 50 different industries, which we would deep dive into each of the industry one by one. We would look at what is happening in that industry, right? What kind of projects are getting implemented, what are the pain areas in that industry, what kind of things the clients are talking about, so on and so forth, right? So the first up, we are going to talk about insurance. So that's our first, domain or industry that we'll look at, and we are going to start off with the basics of insurance today, right? So, having said that, what is insurance, right? So this all of us know. We have been interfacing with different insurance products for some time now, from our early age. So we know that insurance is a way of managing risks, right? Managing or transferring risk, whatever you may call it, right? Why do you take insurance? Because anything can happen to us at any point of time, right? So from a life perspective, from a health perspective, or from different other general perspectives, right? So insurance is a form of risk management where one party, that is the insured, that is you are transferring the risk to another company or to another party, that is the insurer, right, which is the company, and in exchange of that you're paying a premium to that company. So that these are the key things, key terminologies in the definitions of insurance. So who is an insured, who is an insurer, and what are you paying, right? The insurance company is said to provide you the coverage against this premium that you are paying the insurance company. What is coverage? Coverage is the total amount that you are entitled to pay once the incident happens, right? So this is the definition of insurance, which is explained here through an image. So this is saying that the insurer, that is the company, is providing coverage to you, who is the insured or the policy holder, and against that you are paying a premium to the company in whatever installments your the policy says, right? It can be yearly, quarterly, or monthly. You are paying a certain amount to the company, right? How is the amount decided? What is the amount? Will come. We are just coming to that, right? So now, before going into deep diving, what we need to understand, we have spoken that insurance is a way of managing or transferring a risk, right? So what are the different ways you can handle risk? That's the first thing we have to understand, right? So say for example you're in a COVID situation, which all of us have been in the last 2 3 years. So you can, firstly, you can control that risk, right? You can wear mask, you can carry sanitizers and things like that. You are controlling a risk, right? But you yourself are doing it. You can accept the risk. What do you mean by accept the risk? So for example, you are, you don't bother that much and you are not wearing mask and you are going out in the road and in public transport and things like that, and you accept the risk. You accept that the thing is there and I have to um, um, uh, go by that. So you're accepting the risk. You're not trying to protect yourself. You can transfer the risk, right? That's another way of handling it, right? So that way you are protecting yourself. I don't want to get exposed to this risk. I'm transferring the risk to somebody. So say for example you are in the taking the same example, that you are in a COVID situation, you are in the home, but you want to buy some medicine, right? You yourself don't want to go out. You don't want to use your mask and all and go out. Rather, you are asking somebody else to buy that medicine for you, right? Somebody else, you're requesting your neighbor or friend to go out and buy the medicine. In this entire process, you're transferring the risk from you to that person. Or you can avoid the risk. You don't do anything in this situation. You just stay home, right? So out of these four things, this transferring the risk is the basic premise or the bedrock of the insurance world, right? Now, coming to what can be insured, right? We spoke that transferring risk is nothing called insurance, right? Now, what kind of risks we handle? So there are two types of risk. One is a pure risk, where there is always a chance of a loss, like our life. We will always die at some point. Or there is speculative risk, where there is a chance of having a gain or a loss, right? So investing in share market is a pure example of a speculative risk, where you invest in a share and the share price can go up, thus giving you gain, or it can go down, giving you loss. Now, the reason we are saying all these things is you can only insure pure risk. You can never insure a speculative risk. Keep that in mind always, right? Now, what are the characteristics of the loss that that happens in insurance, right? Obviously, because of risk, there's some incident that will happen, right? And you are basically taking insurance against that incident or the loss, right? So the loss must follow certain definition, right? So the loss must occur by chance. So you can't obviously preempt an accident and say that, oh, see, this has happened and that's why I'm claiming an insurance. No, that is illegal, right? It must occur by chance. It must be definitive. There must be a certain, it must be calculatable. There has to be a time bound thing and things like that, right? The incident can't be, it can go on for indefinite amount of time. The loss must be significant. So, say for example, today you're just walking in the road and you fell down, and then you just wounded your knee, and you apply some Dettol and bandage, and you're done, right? So, against that loss, you can't go ahead and claim an insurance. The loss, by definition, it says it has to be significant, right? So, say if you're traveling by a car, and then something hit the car, and then it was a serious damage, you have to be hospitalized and things like that. Then you can always claim an insurance for that incident. Loss must be predictable. So you can't insure something which is not even predictable. You can't even think of that situation. You can't insure that loss, right? And loss must not be catastrophic. So normally when you buy an insurance, they say that, say for example, you buy an insurance for a house, but because of some earthquake, your house falls down, we are not, liable to pay for that insurance. I mean, that's what the company says, right? So the loss must not be catastrophic. That's what we are saying. Now, what we are looking at what are the different types of insurance, right? So the entire world of insurance can be broken down into three main pillars, right? One is the life insurance, health insurance, and general insurance, right? Now we will go into the details of all these lines of business and insurance in our upcoming, videos. In terms of general insurance, I've just given some, the names that we will cover. So within general insurance, we'll cover auto insurance, workers' compensation, your travel insurance that you buy, any kind of property insurance, be it your own homeowner's insurance or some commercial property, then any kind of liability insurance, right? Any professional damage, those scenarios getting covered in liability insurance, indemnity insurance, and things like that, right? So that these things fall under your general insurance. Then we have life and we have health, right? So now just covering and touching upon the key terminologies within the world of insurance. So we have spoken about contract, right? So what is a contract? Contract is nothing but the legal thing that is getting signed between the insured and the insurer against the consideration of the premium that you're going to pay. So this is the contract, which has all the all the the terms and conditions, right? So this is the amount that you're going to receive. This is the coverage that we are going to cover. This is the time frame within which you can do the claim after the accident, so on and so forth, right? What is the premium? Premium is the exact amount or the total amount that you are going to pay the insured company against which you are buying the insurance coverage, right? Who is an agent? Agent is basically a channel through which we buy the insurance, right? So all these years we used to buy insurance for, say for example, life insurance corporation. There's a lot of agents of that company, and then we go to one of the agents and then we buy insurance from that person. So that person acts as a channel for buying insurance. Now the days are changing, and we are slowly buying insurance for all these online portals, which conglomerates, a lot of companies in one portal, or we have individual portals also. We have mobile apps through which we buy insurance, so on and so forth, right? Then what is a coverage? A coverage is the total amount for which you are insured, right? That is the total amount that the company is liable to pay you in case the incident happens, right? That's the coverage. What is the policy? Policy is the legal document within which all the legal contracts that we've spoken about will be written, right? Which will contain the details of the, the claim, what kind of claims you can do, what are the, say the hidden costs which are there, what is the time frame of the insurance, what is the total coverage, what are the things which are covered and not covered within this policy, so on. These kind of things, right, are covered within policy. Underwriting is a very important department of insurance who decides how much premium you're going to pay for a particular insurance, right? It depends on a lot of things. It depends on your personal habits. It depends on your professional, data and things like that. So say if your health is better, right? If you're a non-smoker, and if you do a lot of exercises, then your chances of getting admitted to a hospital is much less. So obviously the amount of premium that you pay to the insured to the company is less. And if the opposite situation happens from your data, if it finds if it's found out that you are highly prone to diseases and things like that, then obviously your payment of installments will go up, right? And these calculations are getting determined by the underwriting team. So that's what is underwriting. And claims is the reason all of us buy insurance, that whenever the loss happens, whenever the incidents happens, there's a certain way, and differs by company to company, we do the claims, right? We fill up a form, we upload certain pictures of the card that has got broken and things like that, and then we submit the claim for it to get settled slowly. So that these are the key terminologies of the insurance world. And now we'll look at a very important thing, which are the 7 principles of insurance. Okay, so what are the 7 principles, right? The first principle says the principle of insurable interest, right? The reason why I'm doing the insurance is a product which I need to own, right? If I don't own the product, if I don't have interest in that product, then I can't go ahead and insure that product. So that is called principle of insurable interest. The second thing is principle of utmost good faith, right? So the first thing is, whenever you are going to an insurance company, you need to furnish your information correctly to that company, right? Without which you can't go ahead and buy insurance. That's the second principle. The third principle says principle of indemnity. This is the most important principle, which says that you can't claim an insurance to do a profit, right? You can only, claim an insurance to compensate your loss. That's the basic premise of doing any insurance, right? The fourth one says in principle of contribution. So say for example, today you have multiple health insurance, right? And then something happens, you are hospitalized, you claim insurance from one health insurance company, but this company will find out that if you have insurance from any other company or not, and this company has the right to share the entire coverage with all the 3 companies with which you have bought the insurance. So that's called principle of contribution. Principle of subrogation is another very important principle of insurance, which says that the ownership gets transferred to the insurer after the claim is paid to the claimant, right? So say for example, your bike is totally damaged, you claim, the insurance company pays you. After that, the ownership of the bike gets transferred from you to the insurance company, right? And not only that, this insurance company or the insurer has all the right to now take the payment from the third party who has caused the damage. So say for example, some other car or some other bike has hit you. So that is the third party, and this insurance company, your insurance company, has all the right to now basically claim this third party to take the money, right? Whichever the company has paid you. That's the principle of subrogation. Now the principle of loss minimization, what does it say? So say for example, fire has broken out in your home, right? And you are present in that in that situation, but you are not taking any action to douse the fire, right? That is not what the principle says. The principle says that you should always take all measures and action to minimize the loss that is happening, right? And the last principle, which is the principle of causa proxima, this is a very interesting one, that says the nearest or the closest cause is why the incident occurred. The closest cause will be considered as the cause for why the incident occurred, right? Here also I'll take a example. So say for example, a ship is getting is sailing from one country to another, and the ship is carrying a lot of consignments along with it, right? And say consider that there are a lot of rodents in the ship, and they have created some hole in the consignments, and as a result water has seeped in into the consignments, and that's why the consignments are now damaged. So there are two things, if you think minutely here. One is the rodent has caused some hole in the consignment. The second thing is water has seeped in into the consignment. There are two reasons why now the consignments are damaged. But because water seeping in into the consignments is the nearest cause, that's why it will be considered as the cause why the incident has occurred, right? So that is what our last principle, which is the principle of causa proxima, is saying here, right? So I would request all of you to keep these 7 principles in mind whenever you deep dive into any insurance use case going forward, right? So that's all we wanted to cover today. So we have covered the principles of insurance. We covered what are the basic features of insurance, the key terminologies. What are the three pillars of insurance? Then what are the losses in insurance and how you will define the losses in insurance? What are the different kinds of risks in insurance and what kind of a risk can be insured? And we started off by defining what is insurance, right? So that was today's topic. Hope you found it interesting. I would definitely look forward to a lot of feedbacks and how we can update our contents and the way we can change our discussions and things like that in the upcoming videos and as well as in the comment section. Thanks all for listening in. We'll see you in the next video.